Up first, let's tackle gold prices, which have been on this upward trajectory once again. The lustrous metal touching 69,000 rupee mark on the MCX today and currently hovering around 68,000 rupee. Now on the COMEX, we've seen gold hit $2,256 per ounce. It comes as one of the kind of subdued inflation kind of outcome in the US and also the possibility of an increase in exchange-traded funds. Earlier today, we had a word about gold prices with Suvankar Sen, the Managing Director and CEO at Senco Gold, who says the company is going to continue to give offers and discounts to customers just to maintain the footfalls. He also mentions that margins are going to see some amount of pressure because of the higher making charges. Listen in to what he told us earlier.
You will end up seeing a lot of discounts and offers because consumers at one end will be happy that yes, the assets that they have stored in their lockers, the prices are going up. Gold cannot be considered as a dead asset anymore, especially what you've seen in the last 4 or 5 years. But at the same time, to keep attracting the consumers, we will have to continue to give discounts and offers. And that is what everyone has been seeing over the last 1-2 years, that there have been some pressure on the margins. So yes, while the making charges will go up, then at the same time, you will be able to see a lot of discounts and offers also happening parallel.
Well, that's the word we got earlier today. Let's break it down further with Navneet Damani, the Senior Vice President and Head of Commodity and Currency Research at Motilal Oswal Financial Services. Great to have you with us this evening. Do tell us what should explain this phenomenal rise that we are seeing in gold prices, and is this likely to continue?
Well, thank you for having me on the show. We've seen a massive rally coming into gold prices over the last, say, probably 1 quarter. We've seen 8% kind of a return, and the preceding quarter also delivered about 15% kind of a return. The last 6 months, in totality, we've got about 23% kind of returns for gold, and that's a little bit surprising given the nature of gold and given the nature that it follows a lot of uncertainty. Because for the last 6 months, we've not had major uncertainty in terms of war front. We are having a little bit of stalemate kind of a situation. Rates are going to be cut from the US Fed, and that's a very known phenomenon ever since the year started. And it's going to be 3 rate as we approach the month of June, which is kind of built into the prices. So most of the traders and probably the market participants have been taken aback by the last $150 kind of a run up, which have impacted the gold prices. So from my point of view, I would think that a little bit of exuberance is already getting into the prices, and some bit of cool out could be warranted as we approach, say, probably this the second quarter of 2024.
Some cool off is expected, but like you mentioned, the factors that are at play, there is this kind of uncertainty, global uncertainty, the war factor, but there are hopes of interest rate cuts by the Fed also that are, like you mentioned. And of course, there could be as many as 3 this year, like has been about, but also banks could buy more gold as a safe haven. So are prices likely to keep rising through FY25? Overall, how do you expect gold to do as an investment class in FY25?
Well, central banks have been buyers for gold a huge amount of gold for the last 2 years. In 2022, they bought over 1,100 tons of gold. In 2023, it was about 1,050 tons. So they've been buying a decent amount of gold in the last, say, probably 2.5 years. And this quarter, the last quarter would have also been reporting substantial number. We still to await those numbers. But let me tell you, commodities by nature are cyclical. As and when there is a shortage of material, prices tend to increase. But what typically is going to happen is a lot of second sale is going to come into the market at these levels, because you've seen about 23% kind of returns in a matter of no time. So second sale is going to impact the market, and then probably at these levels, when you talk about gold at 70 lakh rupees per kg, there is going to be demand destruction. So demand front, it is going to be slow. Supply front, there is going to be fresh demand which is going to come in, and which is going to keep the market prices capped. So my bet is that if this would have happened in the last quarter of 2024, it would have been more comfortable. In first quarter of 24, we are a little surprised by the exuberance of the rally, and we would wait for a reasonable cool off or correction, either price wise or other type wise, before any meaningful investment in gold.
So, Mr. Damani, since you're talking about this cool off likely to happen, as far as in this interim period, how is demand likely to be hit? We got a word in from Senco in the day as well, and they're talking about higher discounts just to ensure that there is this footfall. Do you think that there would be a lot of demand destruction because of this kind of spike that we are seeing in gold prices? Typically, historically, what do you see when gold prices spike the way they are?
Jewelers are typically sitting on a lot of inventory, and of course, to clock on to that, they would offer discount because prices are at quite reasonably elevated levels. As I told you, 25% returns in a matter of say 12 months is where they are making reasonable profits, and offering discount is one part of the game. But as far as bullion dealers are concerned, they are typically the ones who are going to have a little bit of stalemate kind of a situation. And I think demand at this point, as we speak, is very shallow. We need a reasonable price correction because as individual also, if you understand that something which was worth say 61 62 lakhs about 6 months back is 70 lakhs, so I would refrain my purchase on a personal front. So I don't expect that to happen from so a lot of other market participants. So price correction is typically the idea, or maybe a time wise correction where prices stay around 69 70,000 for a limited period, and that is when typically you will start having fresh buying coming in. Globally, this has been the norm that once prices jump up by 4-5%, you see a little bit of slowdown or demand destruction. But here you are talking about a 20% plus kind of a movement. So that is going to be a massive time where people get acclimatized to the higher gold prices.
Quickly, in that kind of scenario, Mr. Damani, as an investment class, what do you recommend investors should do? Where does gold fit in now? Is this the time to book profits?
Well, of course, I would believe that a certain amount of profit taking has to be done because we've seen a reasonable amount of run up in the last 5 years. It's giving you about 60% kind of returns. So some a bit of profit taking could be witnessed. For fresh buyers, I would advise to refrain from buying at these levels. You could see a reasonable correction, or probably some geopolitical stress has to happen, which is not foreseen at this point in time, for the gold prices to run up from here. So either you could say probably wait to time it for next couple of quarters, or probably you wait for a reasonable correction towards 64, 65,000 or $2,100 on the international front before making any kind of investment.
Very useful advice. Thanks very much, Mr. Damani, for joining us with your perspective on gold prices, which indeed have been spiking.